morning we're going to do a little bit of a commodities outlook. So, just looking at all of the various impacts on supply, demand, pricing for metals. So, joining me here today, I've got Derryn Maade, Global Head of Metals and Mining at Wood Mackenzie, and Manjot Singh, Senior Analyst for Commodity Markets at Molycop. So thanks for joining me this morning. Maybe you want to start with just a quick introduction, share a little bit about your experience with the audience.
Shall I go first? Hi, everyone. Packed audience today. That's great. But thanks for joining. And just to give a little bit of an introduction, I'm Derryn Maade, as Amy's rightly said. Been in Singapore for the last 4 years working with Woodmac. My background is as a mining engineer. I've worked for Anglo American in a number of jurisdictions, managing operations, as well as doing technical and business development work. And then joined the investment banking community on the equity research side, covering metals and mining for a number of years before making the move over to Singapore, where I've been since the end of 2019. So, looking forward to the conversation.
Thanks, everybody. Good morning to all. My name is Manjot Singh. I'm a senior analyst at Molycop. We are a mining consumables business providing grinding and crushing products and services to the mining industry. We are buyers of metal, primarily steel. We ship this steel to different plants worldwide where it gets converted into this finished grinding product or grinding media, which is then sold off to the mining industry, primarily copper producers, gold producers, and iron ore producers. And I am kind of contributing in the group's procurement strategy and to some extent to the commercial strategy as well.
All right, great. So, since we have a small audience today, I thought it would be good, let's keep it quite conversational. I want everyone in the audience to think of a question to ask our panelists as we go. So I'll be calling you out later. But maybe just to kick things off, let's start looking at kind of the macro environment that we find ourselves in. So, we've got China's difficult rebound from COVID, the ongoing war in the Ukraine, a high inflationary economic situation. So how does all of this, how are you finding, all of these macro issues impacting the metals and mining space right now? Maybe Derryn, do you want to kick us off?
Yeah, sure. I think you summed up kind of the key drivers there quite nicely. Obviously we've got an industry where mine commodities are impacted significantly by the macro environment. It's been dominated by high interest rates, I think, over the last year. Stronger than expected US growth within that environment, which has obviously, been welcome to the industry. But I think the clearly, price impactful macro has been weaker China. And there's a number of aspects going on there. You look at the Chinese response to its own economy, that seems to be constrained by the inability to really pull any meaningful fiscal levers at this point. So largely due to high levels of debt. I mean, government debt alone is 50% of GDP. If you factor in all debt, including the shadow banking sector, you're looking at multiples of that. I think there's some figures at 280% of GDP. So that puts the government in a very constrained ability to react to what's happening, to actually address things like weaker domestic demand, low consumer sentiments, all of these factors that are really impacting the weakness of that economy. So that leaves one real option open, and it's the lever that they're pulling now, and that's monetary stimulus. So reducing the reserve rates, making life more affordable for the average consumer, as well as then freeing up the ability of local government to buy government bonds and try and reinvigorate the domestic economy along those lines. That can only go so far, I think, and you're seeing it in, I think, what is more of a stabilization at a lower growth rate rather than a reinvigoration of growth that we've seen now. And that obviously has big impacts on what we forecast for Chinese consumption rates of key metals, iron ore, for example, copper, and of course, the battery industry as well.
Yeah, you covered quite a lot there, Derryn. Probably let me just take a step back, kind of recap why we are where we are right now. Of course, there was a certain geopolitical event that took place last year in Russia, Ukraine, which kind of led to a complete redirection of energy and a lot of other trade flows as well. The impact on global supply chains was significant, which was highly inflationary for the global economy. As a result, of course, we are seeing inflation rates, or we saw inflation rates that were at a multi-decade high. That led to a response by the central banks in terms of monetary tightening. And of course, with that significant amount of monetary tightening that we've seen over the last few months, we are starting to see a bit of a downside impact on raw materials and some commodity prices more recently. So that's how it was all brought about. Uh, at the start of the year, of course, there was some irrational optimism, at least regarding China, with China starting to come out of the COVID zero policy. A lot of the estimates or forecasts that I was seeing out there were that China is probably going to be doing pretty well this year, whereas the Western economies are going to be weighed down by the stringent monetary tightening regimes that we are seeing. But as it turned out, the Western economies, at least some of them, especially US, has turned out to be pretty resilient for now. But it is China where the major troubles lie, as Derryn pointed out as well. Structural issues with the real estate sector in China for sure, which has had a major impact on some commodities, especially steel. As a result of that, and because inflation outside of China has been very, very sticky, we are seeing that manufacturing industries outside of China have been disadvantaged by these inflationary pressures that we've observed in the last 10 or 15 months. So if you just look at what's happened this year, manufacturing sector hasn't really performed well. Manufacturing has stagnated to contracted slightly. And because inflation has been very, very sticky, the economies outside of China have been disadvantaged in terms of their costs of production. And as a result of that, you are seeing China dump a lot of product into the international markets. Steel exports from China this year are about 30% higher year on year. More recently, it's all over the news that China is on track to become the world's largest automobile exporter. The EU right now is considering retaliation measures on Chinese electric vehicles. Time will tell whether that will be able to be implemented or not. But not only is the Chinese domestic economy, not only the growth there has been mixed, and not only has the construction sector in China been very, very bad, as a result of the weakness in the domestic market, China has been exporting a lot of product into the international market, which of course is having an implication on those prices and those markets as well.
I mean, do you think that there's been a lot of kind of growth in regulation about, domestic supply chains, and keeping metals kind of within regions? Do you think China's export of all of these metals is going to kind of change the ways that these governments, like the U.S. and stuff, are implementing new regulations on them?
I'll take a stab at it first. And I think if you look at what the biggest sort of global tension is at the moment between the US and China, it's really all around the supply chains related to renewable energy. In particular, certain commodities such as rare earths, all of your strategic minerals that have been identified, to the point where there's even mining companies within China that are facing scrutiny now recently in terms of what kind of information are you generating, how are you safeguarding that data, all of that kind of stuff. So it's gotten to a point where I think China is actually reacting now, looking internally at what foreign companies are generating in terms of intel on these commodities. So definitely stepping up a level, definitely ratcheting up a level. And I think that is going to remain the number one global concern for those two countries, is how they actually, secure those strategic minerals. The point, though, is that the West is significantly far behind China in terms of its developments. China has taken a business model that has been to vertically integrate all of the development of of these minerals. So you look at nickel, for example, right in Indonesia, $30 billion investment gone into that country by China alone, all on a model that seeks to create metal at the end of the day, right? Taking right from production right through to final battery grade product. And I think that's a model that the West struggles to replicate, because the West looks at financing each stage of the value chain differently, different costs of capital at each stage, different type of investors, different type of appetite for risk. And so you never really get a holistic value chain built out in any one go. And I think that, combined with being slow to react over the last 10 years, has seen China really dominate that supply chain, and that dominance is not going to go away.
I think some of the major themes that the world is going to grapple with in the next few years is going to be artificial intelligence, chips manufacturing, and creating that localized green infrastructure. And this third aspect is where the metals and mining industry has to play a big role. And in order to create these localized green infrastructure systems, I think a lot more regulation is being worked on. A lot of incentives are trying to be worked on. A lot of policy is trying to be worked on. Again, an example of that would be the IRA implemented by the US. Yes, it's a novel idea to kind of develop localized supply chains around green infrastructure, but there are huge and significant challenges to make that work, as Derryn just pointed out. The reliance on China for battery manufacturing and for battery component manufacturing is huge. Cells and other parts that go into battery manufacturing, I think China dominates a more than 80% share in that. So in order to shift all of that supply chain, make it localized in certain parts of the world is going to be extremely challenging. Another thing that we kind of discussed briefly, the last few weeks or days, is that it could potentially lead to the creation of parallel supply chains. And a risk is that it could lead to lower utilization rates in the downstream industry. If it's a success, of course, it would lead to more private investment, more jobs creation, but there are huge risks surrounding that. It's a bit of a political issue as well, whether the policy will continue, whether it will continue to garner all that support that it so far seems to have garnered. A lot of question marks around that, but yes, because of the themes that I mentioned, there are some regulations that are being implemented, some policy developments taking place along this front.
Before we move on, do we have any questions from the audience?
So we've been watching iron ore prices and copper prices to a lesser extent, waiting for them to come off with the construction issues in China. Obviously, huge demand factor. I guess we've been surprised by the strength of both of those commodities in the face of this, and recently they've been actually quite strong. I'm assuming the demand's coming from the electrification side and the auto side, obvious. In your supply-demand models, you must see where there's like a period, whether it's 1, 5, 10 years, where electrification trends end up taking over from the construction industry in China, which at the moment feels like it's got a long way to go before it ever comes back to what it was in the demand models. I was just wondering about, or whether there's something else, who else is buying copper iron ore at the moment?
Yeah, I think on the copper sides, we see that market being driven by more the supply dynamics right now than, and I think the sentiment around supply is the important part. rather than what's happening on the demand side. I think demand from the energy transition and electrification, as you point out, is being ingrained now in people's forecasts and as well as how they look at that market, as there's a wall of demand coming in within the next 10 years at some point, right? I think demand in that interim period is going to be reflective of I think world growth dynamics and what happens in China domestically. So stable for now, I think is probably where we see it, not stellar growth. If you have a look at the supply pipeline and importantly the sentiment around that, you see a number of large-scale projects delivering now and into next year in copper. So we almost see this period of supply peaking in the short term into around, I think it's around the middle of next year. You also look at then the project pipeline after that, and there's it's quite healthy. There's a number of projects coming through, but if you kind of extend that out to 10 years, so 2033, and start to look at what we term a theoretical supply gap, so looking at committed supply where investment decisions have actually been made, so not just every single project that's available, but those that are actually attracting funding or companies have publicly made an investment decision about it, you actually get to a period where you're short about 20% of the total demand picture in terms of supply matching that. At what point that happens is, that's open to how the market moves. But we think that as we project out to 10 years, you're definitely going to come in short on investments, and there's going to be a price response to justify further investment in that market. Yeah, sure. Yeah, so there's Congo, there's South America as well, would be the two main areas. Yeah. You want to have a crack?
Yeah, of course. I mean, as India embarks on that journey of urbanization, construction, building infrastructure, steel is going to have to play a big role in there. But India is pretty much self-sufficient in iron ore. Uh, so yeah, there's not a big iron ore story as far as India is concerned. India kind of imports mostly all of its high quality coking coal needs, which could play into the international steel making costs. So, if the local domestic steel build outs in India come into fruition, the ones that are planned, India is going to be importing far more coking coal from the international market, which means that international steel making costs could go up. But India, as I said, is pretty self sufficient in iron ore, so that's not much of a story as far as India is concerned. Regarding copper, I think I agree with Derryn here. I think the demand supply deficits might start emerging from 2025 onwards. The numbers that, of course, we are seeing, and Derryn, correct me if I'm wrong, the CAGR or the growth rates that are projected for copper demand for the next 5 or 6 years are about 3%, 3.5%. If you look at global steel, it might be close to 1%. So if I have to just kind of draw parallels between the two commodities, steel grows at about 1% because construction in China, China grew on the back of this massive construction boom. We might not see the same growth rates for steel because of stagnating construction in China, but copper is a different animal altogether. It's going to be, garnering significant amount of electrification demand. And for those reasons, you're going to be seeing growth rates as high as 3%, 3.5% CAGR for the next 5 or 6 years. But the deficits in copper probably start to emerge in a couple of years from now. Now, what that means is, you're right, prices will have to go high enough to incentivize new mine supply. That's number one. But the reality is that the timelines or the lead times to bring a copper mine up and running is at least 10 years. Those lead times are about 10 to 12 years. And I was speaking to somebody yesterday. You can get a smelter up and running in about a couple of years. You need about 12 years to get a mine up and running. So how that will happen is a big bone of contention. But imagine a world where copper prices go up. So theoretically, either prices can go up to incentivize new mine supply, or prices can go high enough to incentivize recycling. So recycling will have to play a big role in kind of meeting that demand supply gap. The third thing that could happen, at least theoretically, could be substitution. So if copper prices just go out of whack, then you will see some of that copper start to get substituted with some other materials. Time will tell which materials will prove out to be the most efficient in terms of use cases. There could be a fourth factor as well, something to keep an eye out on, which is new technology development. I've read some estimates which project that there's still about 43 million tons of copper that lies in tailings worldwide. If tomorrow prices are high enough and some of these nascent technologies can be commercialized, which are able to extract this copper from the tailings worldwide, that again could fill up some of that demand supply gap. So we are a commodities industry. Whenever prices go up, there has to be a reaction from the supply side or from somewhere. So either new mine supply will have to come from somewhere, or recycling rates will have to go up, or new technologies will need to be incentivized. Otherwise, the final end users will substitute copper for some other product.
Absolutely. I mean, maybe just continuing on that conversation, looking at these supply deficits in, especially amongst the battery metals. So not just copper, but all of the other kind of key metals in this space. Are these deficits going to be as dramatic as analysts have been predicting? What do you think?
Probably not as dramatic as some of the numbers I've seen out there. We tend to be a little bit more conservative on our EV projections than most other houses. But I mean, I think the bottom line is that the energy transition is moving ahead, and people are getting more and more comfortable with what that means in terms of how the world's energy needs are going to be met in the future. I think where we stand now is really a question of how does that transition take place. There's a lot of talk about it being just. There's a lot of talk about making sure that the lights stay on, and as we've seen through various recent energy crises, that becomes a really strong political talking point when prices go up, and when supply of energy is not available into certain countries. I think if you have a look at which metals stand out in that, well, I mean, everyone turns towards the battery materials. It's something that we've been talking about for some time. Again, talking about a theoretical supply gap on a 10-year basis, looking at the difference between demand and what is committed supply. So not the entire pipeline, but what has actually got an investment dollar against its name. You spoke about the 10-year lead time in copper. It's an average of 5 to 7 years in most other metals, and that's been pretty generous with those lead times. So a couple of things that stand out. Lithium, for example. I think there's a lot of talk recently in the market of a wall of supply coming in, but if you look at that beyond the sort of next 2 years and in our 10 years, at what's actually being committed to right now, there's still a supply gap. It's not as big as some of the numbers I've seen out there. On our numbers, we're at about 25% of demand right now, that we see a gap out to 2033, but it's still compelling in that sense. So greater investment is needed into that market. Less so in cobalt on our numbers, because cobalt is more driven by the industrial applications rather than batteries. And there's a lot of concern over its substitution in the battery making process. So we actually see a small surplus in cobalt over that time period. Graphite looks fairly attractive, and as I mentioned, copper really stands out. And when you look across the base metal suite, it's difficult to see where committed supply is actually going to come from over the next 10 years. Different picture on the bulk side. We're with you, Paul, on the view on iron ore. We think it's going to remain oversupplied out to 10 years' time. I think the opportunity there is really when you look at quality differentials between the different types of coals, as well as on iron ore as well. high grade iron ore is going to outperform low grade. I think that's pretty much a well understood fact of the market as we think about decarbonisation and companies paying more and more, or mining companies being forced to look at Scope 3 emissions, and the industry, the refining industry at large being forced to pay more attention to its emissions profiles. So, for example, Australian hard coking coal looks really attractive on our numbers. Low levels of investment, and high levels of demand over that 10-year period.
Interesting. Maybe start off with, say, the energy transition theme and kind of picking on a few things that Derryn just mentioned as well. Yes, the energy transition needs to be just. In an ideal world, we want to be accelerating the energy transition to the maximum possible extent. In fact, Molycop, my company, if in order for the world to decarbonize, you need our product so that new copper mines can come online, more copper can be produced. But yes, I think the realist in me makes me wonder that this energy transition has to be a phased transition. We may not be able to get rid of fossil fuels very quickly. If I have to cite an example from history, back from the 19th century, when the world was still using a lot of whale oil, and the industry decided that we need to transition away from whale oil towards kerosene. It took the industry about 60 years to kind of get rid of whale oil. And within those 60 years, we saw epic market rallies. We saw rallies of epic proportions. So that doesn't mean that whale oil was in a super cycle. I'm not saying that fossil fuels will enter a super cycle. But the energy transition, at least that's what history teaches us, is it has to be phased, and it can take a very long period of time before we get rid of certain materials or certain raw materials, such as coal, for instance, in this regard. So during that 60 years, as I said, whale oil witnessed epic rallies, which was sporadic. It wasn't a structural super cycle for that product. Sporadic, epic rallies whenever there was a distortion in supply and demand. And I think just tying it back to what Derryn is saying, coking coal, people, Derryn just mentioned that coking coal, for instance, looks like a very interesting investment. That's only because a lot of new supply is not being, brought online for various reasons. So likewise, I think that fossil fuels will continue to witness these sporadic rallies over the next few years. But in order for us to enter a structural super cycle, it may not be in fossil fuels. It may be in some other commodities. And again, Derryn touched on some of those commodities. Copper seems to be a structurally undersupplied market. Lithium seems to be a structurally undersupplied market. We have to wait and see when that deficit opens up. Iron ore is not a structurally undersupplied market. Again, just agreeing with what Derryn said. So there will be certain battery materials, raw materials, copper, lithium, potentially even cobalt, but after a few years, which are facing these structural uh, demand deficits or demand supply gaps, which will lead to these rallies in these particular commodities. But at the same time, as the world embarks on this energy transition, and as important as these materials are going to be, uh, the world is going to realize that there's already an existing supply chain for a few fossil fuels, such as coal, and the world is going to continue to rely back on those supply chains in terms of distress. So those sporadic times when the world would find itself under distress, it will go back to the reliable, already existing infrastructure, just like what happened last year. That's when we'll see those sporadic upticks in fossil fuel prices as well. Overall, yes, energy transition is going to be highly inflationary as well. We are seeing governments such as IRA pour all that money into these pursuits, which are needed, which are much needed. All these incentives are required, but based on some analysis and estimates that I've been reading, the $500 billion or somewhere around that number that has been committed under IRA, it could actually climb up to $1.2 trillion. So yes, energy transition will happen, hopefully, but it will come at a huge cost. At the same time, we cannot go from 0 to 1. It has to be a phased transition. And then, yes, at some stage, we need to pivot and move towards an accelerated transition. But during this period, fossil fuels will again continue to be perceived as reliable materials under distress, and because of those reasons, they will witness those sporadic uptick rallies. But super cycles would be more focused on some of the commodities that we just discussed. Copper faces those risks, those upside risks. Lithium could be another one. Where will all that capacity be financed from is something for us to also ask ourselves and ask the industry stakeholders in general.
We have another question from the audience.
We've seen uranium price move up pretty strongly recently. Do you have a view on uranium, that as part of the energy transition? I mean, it's a very emotive commodity, for want of a better expression. But do you see the current prices as sustainable or potentially going higher?
I'll start with a caveat in that we don't actually cover uranium as a commodity, so this is more of a personal view. We have done some work just on the energy side, so the demand side, uranium and its place within the energy transition. We do see it having a leading role to play in terms of baseload capacity. And I think that's slowly starting to be better understood and accepted. You look at countries like Japan that are relooking at its nuclear program despite the Fukushima disaster. There's obviously a strong build program in China, and there's other countries, including the UK, so countries in the West that are starting to reevaluate, nuclear as a viable part in their energy strategy longer term. So I think on the demand side, we're getting a little bit of a resurgence that's taking place globally, and that's obviously spurring on the market and building a bit of positive sentiment into prices that we're seeing now. Supply side, as far as I understand it, and this is probably a little touch out of date, is in terms of mine projects and mine supply capacity availability, that's not the bottleneck within the industry. It's more so in the midstream. So that sort of refining from yellow cake into a usable or a semi, the second stage into a nuclear fuel before it goes into further refining. That's where the bottleneck sits in the industry, and that's where investment needs to flow in. But yeah, I do think that it's probably a long-term structural play into the energy transition as it finds a home within the energy mix.
One of the comments that came out of our recent Melbourne event was that uranium nuclear makes sense for countries that already have the infrastructure in place, but not for those that, like Australia, that don't actually have it.
I'd say probably yes and no, right? It will benefit those that have the infrastructure, but where else are you going to get your baseload capacity from that's clean? I just can't see it coming from unless you're going to build in immense battery systems within your country at a costs that are probably going to be similar to nuclear build program. I just can't see you answering a clean energy question without nuclear as part of that strategy.
All right. So it's interesting because so many of our discussions right now are really focusing on the energy transition. I thought we could look maybe a little bit at the precious metal space. What role do you foresee for the precious metals, in an industry that is really, really driven by this energy transition narrative? Maybe if you don't, I'm not sure if you cover the precious metals in your analyses, but just kind of understanding the role for them moving forward.
All right. Didn't know I was going to be talking about precious metals, but my personal view again is I can say something about gold. I'm not 100% sure, but I think Warren Buffett doesn't really kind of pitch gold as an investment instrument. I think although gold has probably given a CAGR return of about 8% in the last 20 years, I don't see gold as an investment based on my personal preferences. It's possibly not the best investment instrument, but it is probably the world's best insurance policy. I think it's a tried and tested insurance policy which dates back to many, many decades. So whenever you're going to be seeing geopolitical unrest, political uncertainty, macro uncertainty, as we have witnessed over the last few months, central bank gold buying has gone up quite considerably. And despite the fact that interest rates have gone up so much, gold has actually held on to its gains. Gold is still trading close to $1,900 an ounce. So despite a very, very tight monetary regime that we have witnessed over the last 12 or 15 months, gold has still remained very firm. And whenever, as I said, it's a tried and tested insurance policy, and gold will always going to be relevant, for the metals and mining industry, as well as for the economy.
I'll pick up on some of the others there. So we don't cover these as well, so this is more of a personal view. But in the PGM space, there's as relates to the energy transition, obviously, you've got the likes of platinum and palladium that offset vehicle emissions, as the industrial application is really into auto catalysts. Platinum obviously has the jewelry side to it as well, but as we see, longer term through the energy transition and the reduction of internal combustion engine vehicles on the roads, that obviously has a negative structural demand implication for PGMs. The industry is working hard to try and create new avenues of demand, and so you see a strong preference for fuel cells in mining trucks with Anglo American as a key example of that, trying to marry the two sides of the business, right? Create that new demand and decarbonize your operations, and demonstrate a technology that is fairly nascent compared to batteries right now. So I think that industry is definitely going to face structural headwinds before we have a tried and tested vehicle fleet on the fuel cell side. So I think definitely prices will be under pressure there. You're seeing that price convergence taking place between the two as auto manufacturers are starting to look at different chemistries on their autocats. That process generally takes about 3 years, and we're about nearly 3 years into the process, into a time period where you've seen palladium significantly higher than platinum. So I think it's enough incentive for the actual manufacturers to start changing those chemical compositions. So again, I think price convergence is probably a theme there, and weaker demand structurally into a diminishing vehicle fleet of ICE. And then the other aspect on precious metals in the energy transition is silver, which plays into your solar cells. And there again, I think structurally demand is positive. And I think if anything, what we may see is some sort of a decoupling as the demand for silver into solar applications increases. A decoupling between the silver price and the gold price to a certain extent over time. Not in the short term though, but I'm thinking far more longer term.
All right. Do we have any questions from the audience before we start to wrap things up? All right, so I thought we could kind of just, we've got one back here. Sure.
Vanadium. There's a lot of talk about vanadium flow, but it seems to go on for years and then nothing happens. What's your view on this?
What do you mean by vanadium flow? Oh, okay, yeah. Don't really have much of an opinion on that. Look, I think vanadium's application is very much into energy storage systems, right? So that is obviously a key component of the energy transition. It's one that we see that has strong growth applications and potential as the transition moves forward. Hence, we're fairly positive on vanadium's use in that technology into the future. But more than that, I'm afraid I can't give you. Unless you have anything to add.
I think we have a few vanadium companies here today, so they might be able to fill you in on some of the key details there. But yeah, to wrap things up, I thought we could just kind of look at some of the, what do you think are going to be the main themes driving the industry over the next few years? So there's been, these thematic changes or, distinct focuses on ESG, energy transition, geopolitical instability. These have all kind of dominated the conversations. What do you think that conversation is going to be, over the next few years?
I think there can be a lot of themes. I think clearly what we've discussed today, I think the world is going to be needing more mined capacity for critical minerals, for certain battery metals, as we just discussed, such as lithium. So then the question is that where is the financing going to come from? Because number one, I think there's a disproportional capital infusion towards midstream and downstream sectors compared with upstream sectors. We briefly discussed that it takes about 2 years to build up a battery plant, whereas it takes about 10 years or 12 years to build a copper mine or 7 years to build a lithium mine. And traditional financing avenues are starting to dwindle. Banks, at least some of the big banks, the mining industry doesn't really get a lot of brownie points for various reasons. In some cases, for ESG concerns as well. But if the world needs to decarbonize, you need your projects to be financed. One trend that was in the news, more recently over the last few quarters, last couple of years, we are starting to see a lot of the automobile manufacturers, say the Western automobile manufacturers, especially in the US, starting to provide some degree of financing to lithium mines. It remains to be seen whether they'll start taking stakes or whether they'll kind of provide loans and financing in some other ways. But again, if I could cite another example from history, and if we can go back to the 1920s, when Sir Henry Ford decided that he's probably going to run out of rubber to make his automobiles, and he started investing in rubber plantations in Brazil. And it turned out to be an exceedingly treacherous and an onerous task for him to make that work, make that entire supply chain work. Wasn't experienced in kind of running rubber plantations in Brazil. And as it turned out, by 1947, his grandson had kind of sold off all the plantations that he bought over in the 1920s. So I think the industry firstly needs to think from where is that financing going to come, and if the car manufacturers are going to try to be a little creative, it remains to be seen whether they'll take direct ownership, whether they try to come up with other creative ways to finance some of the mined capacity in these critical minerals. So I think the world definitely needs more capacity, and as we've discussed, there is definitely not enough in the pipeline for some of these critical energy transition materials. So that has to be one of the major themes going forward. And again, in the more short term, China, again, Derryn mentioned that in the beginning, China has its wings clipped because of all the existing debt problems there. So they haven't really been launching a lot of stimulus, a lot of fiscal stimulus. But the reality is that the real estate industry in China is in a bit of a bother right now. So how quickly can China emerge out of that situation would be something to keep an eye on. I think a healthy China is still very, very important for the global economy. If China does well, it's still a large part of the global GDP. So it will definitely translate into some positive impacts in the global market as well. So in the more short term, we just need to keep an eye on the pace of the Chinese recovery. For now, it has continued to be mixed. I think there's been a bit of a divergence, as I said, in the manufacturing space compared with the service sector. So the Western economies, to some extent, this year have been resilient also because of the spending in the services sector. As the world came out of COVID, there was a large amount of spending, consumer spending in services such as tourism, travel, leisure. So because of that, the world economy was kind of safeguarded to some extent, at least outside of China. But now, with under the pressure of the tight monetary policy, uh, there could potentially be a bit of a slowdown. I hope it's a soft landing. I'm in the soft landing camp, but over the next 3 or 4 months, we could see a bit of a global slowdown just because interest rates are too high. They will probably remain high, for the foreseeable future. But yeah, that's sort of my summary of some of the short-term risks or themes that we need to keep into mind. The real estate sector in China, how long it takes for China to emerge out of that. The limitations that China has in order to make it work instantly, and then over the long term, when the world needs more mined capacity for some of the commodities that we've discussed, where is the financing going to come from? As I just summarized.
Great.
Yeah, I'll add to that. I agree with most of those points there that you raised. For me, the big theme that's going to dominate our industry from a global perspective is really the West catching up or trying to catch up with China in terms of dominating, securing clean energy supply chains. And I think that has geopolitical aspects to it, continued tensions between the US and China, forging of different alliances, is as they, all countries across the world trying to keep pace with the energy transition and build their own domestic supply chains. But it also has implications for M&A. The West will seek to further vertically integrate. I mean, you touched on OEMs and potentially, getting involved directly in mining. We've seen some part of that in terms of investment, but taking further ownership could be a theme that takes place. And then I think the other thing that the West will seek to build out quite aggressively as the reality of being so far behind starts to bite is the circular economy and recycling. I think scrap generation and handling of battery recycling is going to be a key theme that takes place over the next few years, and hopefully more investments through policy-led decisions, through policies like the US is putting in place for its clean energy right now, the IRA, and hopefully that means better investment into the mining sector as well.
Absolutely. All right. With that, I want to thank our panelists for joining us here today. That was a really insightful conversation. So thank you.